Hi everyone, welcome back to my channel. Howard Marks, a legendary investor and author. For those who are unfamiliar with Howard Marks, he is the co-founder of Oaktree Capital Management, a leading investment firm that focuses on distressed debt and other types of alternative investments. As the co-founder of Oaktree Capital Management, he has helped to build the firm into one of the leading alternative investment managers in the world. Under his leadership, Oaktree has produced strong returns for its investors, even during difficult market conditions. Howard Marks is known for writing memos to clients and employees of Oaktree Capital Management, in which he shares his insights and perspective on the markets and on investing. These memos are widely read and respected in the investing community and are known for their thoughtful and philosophical approach to investing. Warren Buffett once said, "When I see memos from Howard Marks in my mail, they're the first thing I open and read." Today, we'll look into a memo written by Howard Marks. Sea Change, the title of the memo, which describe as a complete transformation, a radical change of direction and attitude. In the memo, Howard Marks stated that throughout his 53 years in the investment industry, he has seen numerous economic cycles, market fluctuations, and significant events. However, he can only recall 2 instances where the changes were truly transformative or sea changes. At this moment, Howard believes that we may be experiencing third sea change. The first sea change came in the early 1970s as investors adopted a risk versus return mindset when it comes to investing. The second sea change came after the Federal Reserve under Paul Volcker in the early 1980s hiked interest rates to eye-watering levels in the effort to wring out inflation, bringing an end to the period of declining interest rates that had previously existed. Volcker's success in bringing inflation under control allowed the Fed to reduce the Fed funds rate to the high single digits and keep it there over the rest of the 1980s, before dropping it to the mid-single digits in the 90s. The long-term decline in interest rates began just a few years after the advent of risk and return thinking, and Howard viewed the combination of the two as having given rise to the rebirth of optimism among investors, the pursuit of profit through aggressive investment vehicles, and an incredible 4 decades for the stock market. The S&P 500 index rose from a low of 102 in August 1982 to 4,796 at the beginning of 2022, for a compound annual return of 10.3% per year. What are the factors that gave rise to investors' success over the last 40 years? The economic growth and preeminence of the U.S., the incredible performance of our greatest companies, gains in technology, productivity and management techniques, and the benefits of globalization. These several factors all contribute to economic growth. However, the 40 years of declining interest rates plays an important role in the economic growth. Howard provides an example of low interest rate. In some airports, there is a moving walkway, and standing on it makes things simpler for tired travelers. However, if you walk at your normal rate rather than standing still on it, you will move quickly forward. This is because your rate of travel over the ground is the sum of your walking speed and the speed of the pathway. Investors benefited from the expansion of the economy and the companies in which they invested, as well as the following increase in the value of their ownership holdings. But in addition, they were on a moving walkway, carried along by declining interest rates. Basically, Howard believed that a significant portion of all the money investors made over this period resulted from the tailwind generated by the massive drop in interest rates. So, how does low interest rate helps in economic growth? First, the low rates and vast amounts of liquidity stimulated the economy and triggered explosive gains in the markets. Then, strong economic growth and lower interest costs added to corporate profits. Valuation parameters rose will lift asset prices. Since the interest rate was low, investors will likely use leverage to buy their assets. And thanks to economic growth and plentiful liquidity, there were few defaults and bankruptcies. Therefore, we can see that low interest rates will not only cause a stock market bubble, but will also raise economic leverage. The 2008 financial crisis was caused by over-leveraging, or excessive borrowing, in the housing market. Besides, Howard Marks also shows a table to compare the differences between past decade and today. Fed behavior changed from highly stimulative to tightening. Inflation changed from dormant to 40-year high. Economic outlook changed from positive to likely recession. In short, the rules of market capital have changed. In the past 40 years, low interest rate led the economic growth, while now is different. Howard Marks believed that the base interest rate over the next several years is more likely to average 2 to 4%. He also forecasts that interest rates aren't about to decline by another 2,000 basis points from here. Basically, Howard Marks thinks that the investment strategy that performed well in the past 40 years may not gonna work in the future. He also believed that highly stimulative rates are likely not in the cards for the next several years, barring a serious recession. Howard Marks thinks that investors should make the investment strategy to more conservative. For example, investors can purchase the high-yield bonds and value stocks instead of growth stocks. This is because the strategy that blindly invests in the stock without knowing the valuation will not work in the future since the interest rate become normal. This is the sea change that Howard said. If you have other opinions, let's comment below. Please help to like and subscribe.